Hey guys, what's up? It's me, Jonathan, and welcome back to Money Talks. Today we're going to talk about the two fundamental ways you actually make money through the stock market. But first, if this is your first time joining me here on the channel, go ahead and hit that subscribe button so that you will be notified every time I upload a new video. So there are two fundamental ways that you can actually make money through the stock market: stocks and bonds. When you purchase a stock, you're actually purchasing ownership and giving what's known as a share of a company. A share is based and priced off the amount that you paid, and its performance of how that rises is based off how that company profits up or down. So that's why your stock can rise and fall and your money can rise and fall, because it's all based off the business's performance. When the company actually does well, you will actually receive compensation in the form of a dividend. But when it doesn't do well, your account, your stock, your money will actually lose value. But you don't necessarily lose value unless you sell the stock when it's down. One way you can guard against this is by purchasing bonds. Bonds is actually when you purchase a bond, your money is actually loaned out to governments and corporations, and they pay you in the form of interest. Now, bonds is a consistent stream of income, but in terms of building wealth long term, bonds won't suffice, because the interest rates that are charged for bonds that you're paid are very low. So you use bonds to actually guard against the volatility of the stocks that you purchase, so that in your account, in your portfolio, you will not see as much up and down movement. Another way you can guard against the volatility of stocks is by purchasing a group of them at one time. A group of stocks put together is called a mutual fund. A mutual fund has a purpose of beating the stock market by performance. Mutual fund is usually comprised of 70, 100, 1,000, many different stocks over many different sectors, with all one goal of beating the stock market as far as performance is considered. Mutual fund companies actually make money through the mutual fund by charging you fees, sometimes by when you purchase or buy or sell of that mutual fund. They also make money through what's called the expense ratio. Another way to actually invest is using mutual funds is called an index fund. An index fund is like a hybrid version of a mutual fund. An index fund is also comprised of many different stocks, but the goal of index funds is they're only trying to keep pace with the market. So the difference with mutual funds and index funds is one is trying to beat the market, the other one is just trying to keep pace with the market. However, they're both good in the sense that your money is spread out over several different stocks at one time, and that again helps you guard against the up and down movement of stock market volatility. Index funds have become more popular because, statistically speaking, index funds have been proven to outpace mutual funds, meaning even though mutual funds are geared to actually beat the stock market, typically they don't actually do it majority of the time. However, also mutual funds are known to charge less fees, and their expense ratios are known to be very little. So overall, they make for a very efficient way to invest. I personally invest in index funds. Can you tell? Whether you're invested in stocks, mutual funds, index funds, important factors to consider is historical performance, the fees, and the companies involved. Your motivation to actually continue investing is going to be built on the confidence that you have in the company's overall ability to perform well over time. I hope this video was helpful for you, and if you like it, go ahead and give it a thumbs up. And I can't wait to see you in the next video.